The elusive strategies on creating wealth don't have to be so elusive after all. One of the main pillars of wealth building is creating flows of income. There are several types of flows of income, but one of the easiest forms of income is something called dividend income. Easier said than done, dividend income is created by consistent and methodical investing over time that can create substantial recurring income over the long term. But patience is key, along with having the right vehicle and strategies to create wealth and retire early using dividend investing. In this video, I'll discuss the different strategies and techniques the wealthy use to build wealth using dividend income and how you too can create a dividend flow by using a simple portfolio outlined in this video. Get ready, you are now entering the Academy. Dividend income is one of the 7 main flows of income millionaires use to create wealth. What are dividends? A dividend is a payment made by a corporation to its shareholders, usually as a distribution of profits. When a corporation earns a profit or surplus, the corporation is able to reinvest the profit in the business and pay a proportion of the profit as a dividend to shareholders, also referred to as dividend income. Not all companies offer dividends. Dividend yield represents the annual return that is expected to be paid out in dividends. So for example, a dividend yield of 3.2% represents an annual return on investment of 3.2%, broken up into quarterly payments usually paid out every 3 months throughout the year. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can provide substantial income even to cover everyday expenditures. Without further ado, here are 10 high-quality dividend stocks yielding on average above 4% that should fund at least 20 years of retirement, if not more. These have paid uninterrupted dividends for more than 20 consecutive years, have fundamentally secure payouts, and have the potential to collectively grow their dividends to protect investors' purchasing power over time. The first stock is UHT, Universal Health Realty Income Trust, ticker symbol UHT. It's in the real estate sector and the market value is $1.4 billion. The current dividend yield is 2.7%. UHT is a real estate investment trust boasting 69 investments in healthcare properties across 20 states. Nearly 3/4 of its portfolio is medical office buildings and clinics. These facilities are less dependent on federal and state healthcare programs, reducing risk. But UHT also has hospitals, freestanding emergency departments, and child care centers under its umbrella. The REIT was founded in 1986 and got its start by purchasing properties from UHS, Universal Health Services, which it then leased back to UHS under long-term contracts. UHS remains a financially strong company that accounts for about 20% of Universal Health Realty Income Trust revenue today. The firm has increased its dividend each year since its founding. However, unlike many dividend stocks that hike payouts once annually, UHT typically does so twice a year. The REIT's current 68-cent per share dividend is about 1.5% better than it was at this time in 2018. But as long as management continues to focus on high-quality areas of healthcare that will benefit from America's aging population, the stock's dividend should remain safe and growing. The next stock is Realty Income, ticker symbol O. It's in the real estate sector with a market value of $24.2 billion and a dividend yield of 3.6%. Realty Income is an appealing income investment for retirees because it pays dividends every month. Impressively, Realty Income has paid an uninterrupted dividend for 590 consecutive months, one of the best track records of any REIT in the market. The company owns more than 5,900 commercial real estate properties that are leased out to more than 260 tenants, including Walgreens, FedEx, and Dollar General, operating in 49 industries. These are mostly retail-focused businesses with strong financial health. 49% of Realty Income's rent is derived from tenants with investment-grade ratings. Importantly, Realty Income focuses on single-tenant commercial buildings leased out on a triple net basis. In other words, Rents are net of taxes, maintenance, and insurance, which tenants are responsible for. This, as well as the long-term nature of its leases, has resulted not only in very predictable cash flow, but earnings growth in 22 of the past 23 years. While e-commerce threatens many brick-and-mortar retailers, Morningstar equity analyst Kevin Brown notes that 96% of Realty Income's portfolio is leased to tenants that are protected from e-commerce or economic downturns. Simply put, Realty Income is one of the most dependable dividend growth stocks in the market. The next stock is Toronto Dominion Bank. It's in the financial sector and a market value of $104.5 billion with a dividend yield of 3.9%. Toronto Dominion Bank, ticker symbol TD, is one of North America's largest financial institutions. The bank's revenue is balanced between simple lending operations such as home mortgages and fee-based businesses such as insurance, asset management, and card services. Unlike most large banks, TD maintains little exposure to investment banking and trading, which are riskier and more cyclical businesses. As one of the 10 largest banks on the continent, TD's extensive reach and network of retail locations has provided it with a substantial base of low-cost deposits. This helps the company's lending operations earn a healthy spread and provides the bank with more flexibility to expand the product lines it can offer. Shareholders have received cash distributions since 1857, making TD one of the oldest continuous payers of all dividend stocks. A conservative corporate culture and strong investment grade rating are reasons to believe in the sustainability of this dividend growing forward. Also, management believes the bank can grow its adjusted earnings per share or EPS by 7% to 10% annually over the medium term, which should help TD improve its dividend in the coming years. The next stock is Southern Company, ticker symbol SO. It's in the utilities sector with a market value of $64.8 billion and a dividend yield of 4%. Regulated utilities are a source of generous dividends and predictable growth thanks to their recession-resistant business models. As a result, utility stocks tend to anchor many retirement portfolios. Southern Company is no exception, with a track record of paying uninterrupted dividends since 1948. The utility serves 9 million electrical and gas customers primarily across the Southeast and Illinois. While Southern Company experienced some bumps in recent years because of delays and cost overruns with some of its clean coal and nuclear projects, the firm remains on solid financial ground with the worst behind it. Morningstar equity analyst Charles Fishman believes Southern Company will return to a long-term EPS growth rate in excess of 5% once it finishes construction of its nuclear projects in several years. When combined with the company's payout ratio of near 80%, which is reasonable for a regulated utility, Southern is positioned to continue rewarding shareholders with generous, moderately growing dividends. The next stock is Verizon, ticker symbol VZ. It's in the communications sector with a market value of $250.2 billion and a dividend yield of 4.1%. While rival AT&T has aggressively diversified its business into pay TV and media content in recent years, Verizon has remained focused on its core wireless business. In fact, the company even restructured last year to better focus on its rollout of 5G service. Good news on that front too. While 2020 should see the lion's share of tangible progress, Verizon expects to deliver 5G service to 30 major markets by the end of 2019. It has launched in 10 of them already. Thanks to its investment in network quality, the company remains at the top of RootMetrics rankings of wireless reliability, speed, and network performance. These qualities have resulted in a massive subscriber base combined with the non-discretionary nature of Verizon's services make the firm a reliable cash cow. In fact, Verizon and its predecessors have paid uninterrupted dividends for more than 30 years. Its dividend growth rate, like AT&T's, is hardly impressive. VZ announced a mere 2% uptake this year, but this yield is high among blue-chip dividend stocks, and the almost utility-like nature of its business should let Verizon slowly chug along with similar increases going forward. The next stock is WP Carey, ticker symbol WPC. It's in the real estate sector with a market value of $15.4 billion and a dividend yield of 4.6%. WP Carey is a large, well-diversified REIT with a portfolio of operationally critical commercial real estate, as the company describes it. More specifically, WP Carey owns nearly 1,200 industrial, warehouse, office, and retail properties. The company's properties are leased out to 320 tenants under long-term contracts, with 99% of its leases containing contractual rent increases. W.P. Carey's operations are also nicely diversified. About a third of its revenue is generated outside of the U.S. Its top 10 tenants represent less than 25% of its rent, and its largest industrial exposure is about 20% of its revenue. REITs as a sector are among the highest yielding dividend stocks on the market, given a structure that literally mandates the payout of 90% of their profits as cash distributions to shareholders. But W.P. Carey and its 4.6% yield stick out. Better still, thanks to its aforementioned qualities, as well as its strong credit and conservative management, WPC has paid out higher dividends every year since going public in 1998. It should have little trouble continuing that streak for the foreseeable future. The next company is Exxon Mobil, ticker symbol XOM. It's in the energy sector with a market value of $301 billion and a dividend yield of 4.9%. ExxonMobil is a member of the Dividend Aristocrats, the elite group of 57 dividend stocks that have increased their payouts on an annual basis for at least 25 years on the merits of its own 37-year streak of hikes. But that's not its only impressive dividend feat. The integrated oil major has delivered regular cash distributions to investors for more than 100 years. Despite the volatile nature of the energy sector, Exxon's disciplined capital allocation, conservative use of debt, and focus on complementary business units have made their stock a very reliable source of income over the years. While the oil price crash of 2014 to 2015 forced many of Exxon's peers to cut back on spending and return more cash to shareholders in recent years, Exxon is pursuing a rather ambitious growing plan. Specifically, the company unveiled a strategy in 2018 that would see Exxon spend around $200 billion between 2018 and 2025 to significantly increase its upstream production and chemical production while improving returns on invested capital across each of its business segments. According to the plan, the company's earnings could more than double by 2025. And during Exxon's annual investor meeting in May 2019, CEO Darren Woods said those plans still were on track. Importantly, Exxon expects it can still generate meaningful growth in cash flow even if oil prices head much lower. According to its Investor Day presentation, cash flow would grow 55% between 2017 and 2025 even if oil sank to and stayed at $40 per barrel. If successful, and management deserves the benefit of the doubt, Exxon shareholders should continue enjoying a steadily rising dividend, including the 6.1% payout raise Exxon announced earlier this year. The next company is AT&T, ticker symbol T. It's in the communications sector with a market value of $273.1 billion and a dividend yield of 5.5%. AT&T is a dividend aristocrat that has paid higher dividends for 35 consecutive years, but the company has undergone some rather dramatic business changes in recent years. From acquiring DirecTV to merging with Time Warner, AT&T has morphed into a true media conglomerate with more than 370 million direct-to-consumer relationships across wireless, internet, and video. AT&T is bundling together its unique assets to increase the value of its customer relations, reduce churn, and develop a sizable advertising business. It will take years to assess the success of management's chess moves, which have significantly increased the firm's debt load, but the dividend appears to remain on reasonably sound ground. In fact, management expects the company's free cash flow payout ratio to sit below 60% in 2019, including all Time Warner integration costs. AT&T expects the balance sheet to normalize by year-end 2022. While AT&T's pace of dividend growth will remain moderate during this period, its high yield will provide income investors with some nice compensation as the business digests its recent deals and works on evolving for the future. The next stock is Universal Corporation, ticker symbol UVV. It's in the consumer staples sector with a market value of $1.3 billion and a dividend yield of 5.7%. Universal Corp has focused on supplying tobacco leaves to manufacturers of tobacco products since its founding in 1918. And while it isn't among the aristocrat clique of dividend stocks, that's only because UVV is not a member of the S&P 500. It certainly has the longevity. It has paid rising dividends without interruption for 48 years. Universal is the dominant supplier of the flue-cured and burley tobacco that is grown outside China. UVV handled between 30 to 40% of Africa's annual production, 30 to 40% of U.S. production, and 15 to 25% of Brazil's. Thus, tobacco products manufacturers have little choice but to work with Universal, providing a steady flow of demand. Little capital is required to maintain UEV's core business as well, resulting in consistent FCF generation. However, Universal isn't blind to health and legislative moves across the globe. Indeed, it says world consumption of cigarettes peaked several years ago, and it expects world consumption of cigarettes to slowly decline. Rather than sitting still, the company is directing some of its cash flow into adjacent businesses such as agricultural products that require a specialized processing. Management believes these opportunities could represent up to 20% of Universal's earnings in 5 years. Tobacco-related companies are slowly losing their reputation as can't-miss dividend stocks given regulation and a shrinking business. However, with an investment-grade credit rating and reasonable payout ratio, Universal appears to have the financial flexibility needed to slowly adapt its business model over the time while continuing its impressive dividend growth record. The next stock is Enterprise Products Partners. It's in the energy sector with a market value of $63.2 billion and a distribution yield of 6.1%. Enterprise Products Partners, ticker symbol EPD, is a master limited partnership and one of America's largest midstream energy companies. It owns and operates more than 50,000 miles of pipelines as well as storage facilities, processing plants, and export terminals across America. This MOP is connected to every major shale basin as well as many refineries, helping move natural gas liquids, crude oil, and natural gas from where they are produced by upstream companies to where they are in demand. Approximately 85% of Enterprise gross operating margin is from fee-based activities, reducing its sensitivity to volatile energy prices. The firm also boasts one of the strongest investment-grade credit ratings in its industry and maintains a conservative payout ratio. Its DCF for the first half of 2019 was 170% of what is needed to cover its distribution. That distribution keeps swelling too. Enterprise not only has paid higher distributions every year since it began making distributions in 1998, but it raises those payouts on a quarterly basis, not just once a year. The firm's future looks bright thanks to its strategically located assets, diverse cash flows, and organic growth potential, particularly with regard to Gulf Coast export markets. By employing the portfolio mentioned in this video, you can create a low-risk dividend income flow that will appreciate over time and continue to pay income continuously. Through careful planning and diligent investment of capital, as well as reinvestment of dividends, one can create a dividend income stream that can provide substantial income, eventually covering everyday expenditures and through 20 years of retirement and beyond. The M1 Finance stock trading app provides a great vehicle which allows for commission-free buying and selling of stocks, thus providing a great way to create and grow a dividend income portfolio using the stocks mentioned previously. Be sure to check out the links in the description to get started in creating your very own passive income producing asset and start your path toward financial independence. Thank you for watching this video. If you enjoyed this video, don't forget to hit the like button. And if you haven't done so already, be sure to subscribe to the 10X Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.